This Show. I'm your host, Lance Roberts. Michael Lebowitz, CFA, joining me this morning. You know, one advantage of this whole kind of lockdown situation. Have you ever tried to do your kids' math at school? You know,
impossible.
It's impossible, right? So, because, you know, to solve a simple math problem, they got to have all these boxes, and you fill in the boxes, and it's all this kind of newfangled math way that's very confusing and very long-winded. So I taught my kids to do addition, subtraction, division, you know, the vertical way, the
real way.
The real way, right?
Yeah.
So I've completely screwed them up, but they are so much faster in math. It's incredible.
Oh, yeah.
So they're like, well, we don't have to do all this and get the same answer. I'm like, yeah, just don't tell anybody I told you this.
It'll be our little
I've been
secret.
through those same fights, Lance.
I know, right?
But Daddy, that's not the way they taught us.
I know,
like, do you want to learn how to do it quickly, or do you want to learn how to do it?
Exactly. So yeah, they're you know. So the next thing I'm going to do is teach my daughter cursive. This is the next thing. Actually, the other day she was at dance and I had to go pick her up. And there was, you know, the parking lot was really crowded, and so I was kind of way down at the end, and so I got on my phone and I scribbled in cursive that says I'm here down the parking lot, and I texted it to her, and she gets it, and I can see her. She's about 100 feet away from me, and I can see her looking at her phone, and she's got this very confused look on her face. So I texted her back. I said, "I forgot you can't read cursive. I'm here."
The other thing they can't do is type.
I know, right?
And
they can hunt and peck, though. They're very good at hunting and pecking
with their thumbs.
It's amazing how fast they are.
Yeah, exactly, but they can't actually type with all their fingers. Yeah. Anyway, life issues. Back to the story
old,
here.
Lance. That's
I know,
what
right?
You're really saying.
That's exactly what I'm saying. I am old. So anyway, back to what we were talking about here a second ago. So last Thursday when you were here, Thursday morning, right, this is before the market opened, you and I are talking about this. I had written in the newsletter over the previous couple of weeks that, you know, the markets were very overbought, very extended, and we were due for a correction of 5 to 10%, and that would be well within the normal confines of a market correction within an ongoing bullish market. And then, of course, that Thursday, after we get off the show, the market falls. Friday it falls. Tuesday it falls. And on the NASDAQ, we had a 10% correction in 3 days. We got a bounce yesterday, but, you know, that bounce was on weaker volume. There wasn't a lot of conviction to it. And there was a very big sell order right at the end of the day, and pulled off about a third of the day's rallies, very close to the end of the day. Importantly, the market failed right at the 20-day moving average. So we bounced off the 50, failed at the 20-day moving average, which is typically for people that, you know, if you're not familiar with technical analysis, that's kind of a momentum trend, right? The kind of the average price over 20 days is the direction of the market. That's where it's headed. So, you know, we're starting to see this market begin to deteriorate around the edges here a bit, and we're heading into potentially a very contentious election. And, you know, the question is now, you know, is there more downside risk? We were talking about this a little bit this morning. Just kind of go and get your take on it.
But just let's look back. I mean, we've been talking about this for about 2 weeks, 2.5 weeks, about not necessarily that the market's overvalued, but how overvalued, how kind of crazy and odd behavior was, right? The market, the S&P would be up 1%, and there would be 2/3 of stocks down on a day. Mm-hmm. The market would be up and volatility would be up. And we've seen just a bunch of strange behaviors, or the Dow would be up a lot, the NASDAQ down, or the NASDAQ up a lot and the Dow down. And we've been, you know, this has been going on for 2 or 3 weeks, and it's been getting stranger and stranger. And some stocks and markets were hitting extremes, right? Mm-hmm. We're talking 2, 3, 4 standard deviations from respectable moving averages. And we started to de-risk. We put some hedges in our portfolio. We actually reduced some of our equity exposure. We moved to more value-oriented stocks versus growth stocks. And we were early. But you have to be early, and that's a little bit of the lesson here. And it's hard. It's not easy. It's not easy to be early because the market keeps running. Mm-hmm. But what we've seen is in a matter of, 3 days, 4 days, weeks worth of gains were erased. Right. And it's really hard to take some of those, do some of the things we did a couple weeks ago. It's really hard when the market's already down 5%. or it's dropping sharply. It becomes a panic versus a measured, planned move.
Yeah. It's interesting too, because, we write a lot about this stuff, and it's always fascinating to me is that, when we talk about these things, people assume that we're sitting all in cash, right? We warn about, hey, there's some risk in the markets. We're kind of de-risking. We're hedging here a little bit. And they assume we're 100% in cash. And then, when the market does correct, we get these comments coming back saying, well, yeah, you missed the whole run up. Well, it doesn't really matter if I miss a 5% advance and then you get a 10% correction that takes you back to where you were, 2 months ago, which is what happened. What did you miss? You didn't miss anything, because unless you actually sold the very top tick, which most people don't do, you didn't miss anything. All you did was round trip your portfolio at that point. So the whole point of investing is when things do get extended, more extreme, you take some money off the table, we put it in cash to lock in some profits, and then you have an opportunity to buy back, which we did during the correction. We started adding a little bit back into some of our favored positions that had gotten oversold on a short-term basis, and we'll probably trade those again over the course of the next week or so if we get another bounce. So, but that's just portfolio management, and that's the differential that you've got to kind of separate out between what you read in the media and what really happens within a portfolio. Is that, if you listen to the media, you're all in all the time. They never tell you to sell anything until you've already lost 50% of your money. Then they'll tell you to sell most time. But the point of portfolio management is always about risk management. How much risk am I taking versus what I'm going to get in terms of return?
But there's also a really important wrinkle that is happening today that has not happened in the past. And the fact is that most people have some sort of balanced portfolio, right? It's a 70-30 where you own 70% stocks and 30% bonds, or 60-40 or 80-20 or even 20-80 if you're very conservative. Right. And it's not just individuals, it's endowments, it's pension funds. It's a large chunk of the investment world runs some version of what we call a balanced fund. And in the past, if you had a 60-40 fund, those losses in 2000 and 2008, which were 40 to 50% in equities, were only in the upper teens, low 20s if you had a 60-40 portfolio, because the bonds did really well and protected you.
Right.
Their bonds can provide very little protection today. Most bonds can't, because their yields are close to zero. So the ability for the price to appreciate or yield to go down further is minimal. They're also not paying a coupon worth much. So, we're in a situation where you have to be more tactical on the equity side, right? You can't afford to sit in your 60-40 and think that the 40 is going to protect you from a good chunk of the losses on the 60. So it becomes, I think, even more important to be a little more reactive, to have a plan. Most importantly, have a plan in place. Understand where you would sell, where you would buy, and what you would do if things don't go your way, either going up or going down. But I can't stress that enough, that having a plan and using that plan is much more important today than it has been in our investment lifetimes.
You talk about the issue with bonds, and I agree with you. There's one aspect to this that maybe, what we're assuming here is that yields on bonds can only go to zero. Right. And so you're right. From that standpoint, absolutely agree with you. If yields go from, 0.7% to zero, there is some decent upside appreciation in bonds. That's right. Still a decent, tick lower, and you'll get some definite support from bonds at that point. But we're assuming that yields can't go below zero. But yet when we look worldwide, we've got 14, 15, 16, I don't know what the number is today, but it's 14, 15, 16 trillion dollars worth of negative yielding bonds. Now, these are bonds that weren't issued at a negative rate. It's bonds that have been bought, and the price appreciation of these bonds have gone up so much that there's now a negative yield. People are wanting to buy those securities for protection, and it's driven the yields to negative. And that's something that technically could happen here. I mean, we don't want to really acknowledge that. But if there's a demand for absolute safety, right? I can't go into corporates because of the risk of bankruptcy. I can't go into municipals theoretically because of the risk of bankruptcies with a lot of these cities that are on the verge of bankruptcy already. So as a sovereign wealth fund or as a country or as a institutional investor, maybe one of my only choices for safety, so to speak, is to buy treasuries, liquid safety and security. And it does push yields negative, at least for a short-term period, right?
Right. And if you think about it, why would I ever buy a bond that has a negative yield? Well, you put your money in a vault for safekeeping at a cost. Right. You could think of that cost as a negative yield. If you take $100,000 and stick it in your vault and they charge you $1,000, you're getting a negative 1% yield on that $100,000.
Right.
So, what's safekeeping worth? It's really hard to keep $100,000 under your mattress or even in a vault in your house because there are risks. It can be stolen. It can catch on fire. Okay. My wife could take it and go shopping. I mean, there's all kinds of risks. So a slight negative yield is maybe not that big a deal.
Right. But anyway, just kind of an interesting consideration because we don't assume that that's possible here, but it actually kind of is. Be right back after the break. More with Michael Lebowitz. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.